The most important components of GDP grew at 2% for the first quarter and are trending towards 3% for the second quarter. Is it possible the U.S. economy makes it through this unscathed?
Tariffs are going to stick, and the U.S. economy has to pay for them. We think it's probable the U.S. economy avoids recession, but unlikely that it avoids a slowdown in economic growth.
Thus far in 2025, inflation has been relatively benign. Where are we seeing the impacts from tariffs?
We've seen minimal tariff impact on the goods side of the inflation picture, but the services side, particularly the Fed's preferred inflation measure of core services ex housing, actually went into deflation in the month of April.
So Mike, for this edition of The Outlook, we're starting with economic growth. We know Q1 was negative, but of course we have to adjust for front running of tariffs and inventory building. But taking a look under the hood, the primary drivers of economic growth, consumption, business and residential investment, government spending, taken all together as real domestic final sales, appears to be humming right along. Expectation close to 3% growth for Q2 2025. So with all this tariff will they, won't they, economic uncertainty, the question becomes, is it possible for the U.S. economy and markets to get through this unscathed?
Yeah, because at this point, where you haven't seen any real signs of slowdown in the hard economic data,
Right.
and you've perhaps then got some complacency amongst market participants, maybe even some complacency in the Trump administration. And so, yeah, to your question, can you get through all this mess without a slowdown in the hard economic data? And we just think it's just highly unlikely. So let's go through why we think that. The first, and sort of, we'll talk about the get out of jail free cards from here for the economy. The first get out of jail free card would be the tariffs just continue to get watered down and go away.
Yep.
Easy enough. Yeah, easy enough. The reason why we think that's highly unlikely, even though there was the International Trade Court ruling, and that's going to go to appeal, the Trump administration is going to need to have tariffs as part of the policy mix in order to raise enough revenue to make the tax cuts that Congress is looking to pass in the big, beautiful bill anything close to budget neutral. We talked about this in our deep dive video. The big, beautiful bill, the House version, prices out to something like adding $2.8 trillion to the fiscal deficit over the next 10 years. They are not allowed to include tariff revenue in that calculation, but they did ask the CBO to estimate how much tariff revenue they could collect if the current tariffs that are in effect today stay in effect for the next 10 years, and it makes the math work.
Yep.
So they need it. Congress knows they need it. The Trump administration knows they need it. So they're not going to go away, right? So that's the first thing. There are a couple other get out of jail free cards if the tariffs stay in effect at somewhere around a 13 to 15% effective tariff rate, which is our baseline right now. The other ones would be the US dollar gets stronger on a trade-weighted basis by about the same amount as the tariffs. They would offset each other.
Right.
That is just not happening. In fact, the US dollar has gotten weaker, which is a huge surprise to the Trump administration, when the tariff rollout started. So that's not working. The other thing is foreign exporters just lower their prices.
Yeah.
Just out of the goodness of their heart or other reasons.
They'll eat it.
Yeah, have them eat the cost of the tariffs. That, we don't know why they would do that. There maybe is some evidence that China has excess supply and capacity, and they're shipping out goods at lower prices to the rest of the world just to get the product out the door. There's some of that, but by and large, that's not really happening. So overall, we think the get out of jail free cards, you're not going to be able to play them this time around. There is going to be a slowdown in the hard economic data. That is our base case. It just hasn't shown up yet. But by and large, if the tariffs are going to stick, the U.S. economy has to pay the price of the tariffs in some way, shape, or form, either through slimmer profit margins, which would then result in less business investment or lower employment, lower spending, or those companies are going to pass on the cost of these tariffs to consumers, and that's going to reduce real disposable income, crowd out spending on other goods. But somehow, the tariffs need to be paid for by the U.S. economy.
Yep. And at the very least, they're going to continue to drive uncertainty. Yeah. Will they or won't they? Should I front run these? Are these just going to go away in 180 days? Whatever the case may be. So that's the economic growth side of it. And then inflation, obviously an important consideration for the Fed when they're constructing monetary policy. Starting to see some signs of a potential economic slowdown on the inflation front as well.
Yeah, the inflation data that we have thus far is through April, so it's still a bit early. And on the surface level, the inflation figures have been relatively benign, and there have been a lot of news articles about how tariffs aren't even showing up in the inflation. Maybe companies just aren't passing on the costs. We think if you look under the hood, it tells a bit of a different story.
Yeah.
One, there in some goods categories, prices did go up, as you would expect. But it is fair to say, by and large, companies haven't necessarily had to pass on higher costs because there was so much front running of tariffs and inventory building that they haven't had to restock yet at those higher tariff prices. And maybe they'll have to restock in the fall, maybe it'll be in the next couple months, whatever. But on the good side, there have been some small signs of tariffs. The other way that you're seeing all this uncertainty feed into the inflation figures, though, is if you look at core services X housing. Core inflation, meaning no food or energy. Services, meaning not goods. And X housing, meaning you strip out housing. This is known as SuperCore. This is Jerome Powell's preferred inflation gauge. This, in the Fed's view, is the signal with regards to long-term inflation, and everything else is kind of noise. And what you had in April was actual SuperCore prices going down month over month. That, you would say, oh, well, that's great. Inflation is going down. That's not good. The services side of the economy makes up the overwhelming majority of economic activity. If the services side is reducing prices, that generally means bad things are happening from a demand perspective.
Right.
Meaning signs of economic growth could be slowing. You look at the only other times on this chart where the month over month SuperCore inflation is negative, and they're generally reserved for economic recessions or other temporary slowdowns in economic growth. So that's not good. But of course, there's always second order effects here. We know, we've been saying for a long time here, the Fed is much more likely to cut interest rates than they're talking about right now, than they're leading on.
Yeah.
And the reason for that is we think if inflation starts to rise because companies start to pass on these tariffs more significantly, the Fed will be able to look through that temporary rise in inflation and focus on the slowdown in economic growth and cut rates. Well, if you're trying to look through inflation driven by tariffs for the sake of slowing economic growth, this is going to help you do that.
Right.
If you say the SuperCore measure I love that really drives the bus on the inflation side is in deflation, I perhaps need to be cutting rates.
Yeah.
So there's the silver lining. We still think the Fed is good for 4 to 6 rate cuts over the next 12 to 18 months. That's pretty out of consensus.
Yeah. These developments on the inflation side, in our opinion, give the Fed more leeway to look through the tariff impacts and potentially cut more than they otherwise would. And of course, the other side of their mandate from a job market perspective, we left our viewers with a bit of a cliffhanger from the Challenger Gray and Christmas job cuts announcements index, right? Significant increase there. Still not seeing that come through from a jobless claims perspective, but by no means the U.S. labor market is out of the woods yet.
Right. Yeah, the cliffhanger in that last Outlook video, so sorry about that. So we'll add more detail here. Challenger Gray and Christmas job cut announcements, rolling 3 months total at recessionary levels, not passing through to initial jobless claims. Why? Is it just not happened yet? What's going on? What's happening under the hood there is all of the excess job cut announcements above the level we would normally see at this time in the year are federal government employees. And federal government employees do not file state unemployment insurance claims. So they were never going to show up in the initial jobless claims data anyway. But what we've done here is we've added federal unemployment compensation claims. So now this dark blue line is the initial jobless claims and federal jobless claims, using that terminology loosely. And you see it's still nowhere near recessionary levels. So what gives? These job cut announcements have to flow through somehow. What's going to happen? Well, the federal employees that were part of those job cut announcements, thankfully, they were given the opportunity for early retirement, meaning they're just not going to show up in actual jobless claims data, or buyouts, meaning their incomes are probably whole at least through September.
Right.
So you have to wait until the next U.S. fiscal year. You have to wait until October. Perhaps then a lot of these federal employees will will have lost income and then not be able to spend. That would definitely be a bad thing. Or the other thing here is you don't necessarily need firing in order to get slowing economic growth. You just need a slowdown in hiring. And we're filming this the day before the May jobs report. And that May jobs, it's dangerous to film a video right before a big jobs report, but the May jobs report is going to be one of two things. It's either going to be the first top tier economic data point that shows the slowdown in the hard economic data that everybody's been bracing for, or not bracing for enough perhaps, or it's going to be stronger than expected and everybody's going to say, all right, that was the last economic data point that we think probably doesn't show the effects of all this tariff mess. Every tier 1 economic data point after that, we are looking at it and saying, hey, it should show a slowdown. So it's a bit of a fork in the road, but that's where we're at.
Yeah. So labor market not out of the woods yet. Inflation picture may be showing some signs of economic growth slowdown. Economic growth going to continue to be hampered by the uncertainty and or the drag from tariffs. You add all that up, and it doesn't really seem like a great environment for small caps. Mm-hmm. Can you talk about how we're approaching small caps in this environment?
Yeah, small caps first. There are two sides to our investment framework. The first is the macro. The macro picture we just painted over the next few months, not that great for small caps. The valuation side of our framework still is sort of like a screaming buy within our framework. The long-term trend for small caps since 1960 is about 9.8% annualized. They're 37% below that trend, meaning if they catch back up to that trend over the next 3 years, an investor would annualize something like a 22% total return. So they're very cheap. A lot of bad economic outcome is already priced in. And then what you have from a portfolio management standpoint is if the macro environment is just better than what we're expecting, these should probably outperform.
A lot of room to run.
The other potential here is we just painted this sort of nasty macro picture. If the Fed is willing to look through any increase in inflation to cut rates, then the market might be willing to look through any slowdown in the hard economic growth data and say, hey, this should clear up hopefully by 2026. Then we'll get a little bit of a fiscal boost, at least in the first year of the big beautiful bill. And so I'm going to look through this as well. So it's not all bad, everything we just painted on the macro side. But it does speak to risk managing your allocations, knowing what you own, knowing how much equity you have relative to targets. That all makes a lot of sense.
Yeah. And speaking of risk management, let's help our viewers out a little bit with the nuance around our bond outlook, our outlook for fixed income and particularly duration. You know, in our view, very much tied to the passing of the big beautiful bill, right? With the debt ceiling limit increase that would be associated with that. You know, there's a timing component of the outlook here, right? Diversifier for now, but definitely some need for risk management here in the near-term future.
Yes. When these gray shaded areas are when the debt ceiling is in effect. When the debt ceiling is in effect, as it is now, what happens is the Treasury can't issue net new debt. So in order to pay the bills, they use their checking account at the Fed. It's called the Treasury General Account. And so they've been drawing that down. We think they'll continue to do that until the big beautiful bill is passed, which our baseline there is it's going to be somewhere around August 1st. When that bill is passed, the Treasury has to make up for lost time. They have to rebuild their checking account. They would do that by issuing new debt. Yeah. And as we said in our deep dive video about the big beautiful bill, it's probably going to be longer term debt, 10-year, 20-year, 30-year type bonds.
Right.
As they do that, you increase the supply of new debt, the price goes down, the yields go up. Why do we think this is going to happen? It wasn't too long ago we were in that exact same situation. In 2023, when the debt ceiling was enacted, the Treasury drew down the Treasury General Account to something like $50 billion. They rebuilt it over the next 3, 4, 5 months back up to $750, $850 billion. As they did that, the yield on the 10-year Treasury went from about 3.5% to 5%.
Yeah.
So we know how these dynamics work, but yeah, as you said, diversifier for now, plus the Fed is probably more likely to cut than they're leading on or than the markets think. But once that debt ceiling gets lifted, which coincides with the passage of the big beautiful bill, risk managing your duration is going to be very important.
Yep. So plenty more to come as we continue to navigate the uncertainty that 2025 continues to bring us. But that will do it for this edition of The Outlook. If you have any questions or comments, please feel free to reach out.